So the market goes through cycles, and the last sort of cycle, which has been probably 10 years in the making, has been a growth cycle. So you've seen a lot of growth investments rally. You've seen a lot of companies that burn cash to build a business model be very successful and have big valuations on them. We think over time that some of that silliness and that some of that irrational exuberance will evaporate, and you'll see that segment of the market fall, and you'll see a lot of the value stocks that generate genuine cash flow and sustainable cash flow will re-rate over time. So we can see that the market moving in opposing ways. So we think value might re-rate and growth might de-rate over time. So we've seen market cycles before, and you've seen exuberance in the past. We all lived through the dot-com bubble, which eventually burst, and it took longer than what we thought it would. Now at the moment, you're seeing those FANG stocks in the US get significant ratings. You've seen a lot of companies which aren't listed get significant market valuations, so like an Uber. All of these companies, or not all of them, but most of them burn a lot of cash. And the problem is, one day when the crunch comes and the market does turn off, it loses confidence in these companies. They're going to find it hard to raise money. So these models aren't sustainable. Now, where are we seeing it in Australia? What we've seen recently was obviously Domino's Pizza's got to valuation levels which weren't sustainable. It's a good business. It's not a business that's worth 80 times earnings. It's worth, it's worth probably a premium rating, but not 80 times. And you've seen that stock de-rates pretty significantly. We think there's other market darlings in the Australian sector that will see a similar type scenario where they will de-rate, and that to us presents a lot of risk. So we're avoiding those sort of companies. Financials, for example, we're avoiding at the moment. We think some of the lending out there is pretty crazy. They're lending to people who can't afford to pay the money back, and that's always dangerous. So a lot of these financial companies and market darling companies, we think people are overpaying for. What we're looking for is companies where there's an inflection point. So there's valuation disconnect. The companies generate good, sustainable free cash flow. They have a competitive advantage in the industry, and that's where we're finding good value at the moment. We're finding it in those stocks that are at inflection points.